Hello and welcome to today's A-Team Group webinar. Today we are here to talk about considerations for connecting to and trading on the Johannesburg markets. We'll be looking at the growing interest in the Johannesburg markets and that we've seen among institutional players worldwide. And looking at some of the opportunities that it poses. On this webinar, we'll examine the trading landscape in South Africa, including a look at the key exchanges and venues, brokers, funds, and different data and technology providers that service this market. We'll look at some of the challenges around connectivity and accessing data and analytics facing firms as they seek to participate in these markets, and we'll talk about best practices to make the most of South Africa's increasingly fragmented marketplace. So we're going to get on with the discussion shortly. But before we do, let's meet our esteemed panel who are going to help us discuss these points today. If I could ask the panel please to introduce themselves, starting with you, please, Mike.
Yeah, thanks, Andrew, and hello, everyone. Thanks for tuning in to the webinar. So I'm Mike Powell. I'm CEO of Rapid Addition. So we're a trading technology firm, and we work with financial firms to help them build their own trading solutions based on our technology. And we've been working with South African financial firms for close to a decade now, and work very closely with some of our customers down there. So hence the interest in attending the webinar.
Very good. Thanks very much. Merlin.
Thanks, everyone. So I'm Merlin Raja. I'm the head of the equity electronic product at Absa. Absa is a large international bank, mostly with presence all across Africa with 35,000 people. We offer access to offshore clients looking to trade in South Africa and local clients looking to execute in South Africa and offshore. I look after the high-frequency trading electronic algo piece for Absa.
Very good. Thank you very much. Next up, Kevin.
Thank you, Andrew. And hello, everyone. Yeah, my name is Kevin Brady. I'm a co-founder and the CEO of A2X. A2X is a competitor exchange in South Africa providing choice. We've been operational since 2017. Providing that opportunity of choice and a different platform. Thank you.
Fabulous. And last but not least, Valdene.
Good day, all. My name is Valdene Reddy. I'm Director of Capital Markets at the Johannesburg Stock Exchange. The Johannesburg Stock Exchange is among the 20th largest exchanges in the world and the largest on the continent, serving markets particularly across multi-asset class trading for 134 years. So pleased to showcase South Africa and the trading capabilities and opportunities within our country.
Fabulous. Thank you all so much. Thanks for joining us and for sharing your expertise. I know our audiences are very grateful for the contributions that panelists make to our webinars. They find them extremely useful. So thanks for joining us today. Quick housekeeping before we kick off. We will be using a device called Slido, which you should be able to see on the screen in front of you if you're watching this webinar. Through Slido, you are able to pose questions to the panel. Those questions will come to me, and if they're appropriate, I will throw them over to the panel, and they won't know what's coming. So please do feel free to ask questions early and often, as my old editor at the Wall Street Journal used to say. But also, we use Slido to vote in our polls. So we run polls on these webinars, and we like to engage the audience to get a feel for the mood out there. So when instructed, which is actually now, I'd like you all to go to your Slido and vote in the first poll. And if we may see that those poll questions, I can run through them briefly. So what we'd like you to answer is, this question: what are the major obstacles to trading in South African markets as you currently see them? There we go. Is it the main obstacle that you haven't identified a compelling business justification? Do you lack the expertise to compete? Is it the expense of setting up connectivity/infrastructure? Is it the complexity of setting up connectivity infrastructure? Or is it the inability to convince senior decision makers? So I can see the votes coming in, but rather than watch these bars flip about, we'll come back to the answers in a little while, and we'll get the discussion going right away. So let's kick off with a few sort of framing questions, and I'll go to Valdene first. What makes South Africa such an appealing marketplace for international investors, Valdene, in your opinion?
Thank you, Andrew. South Africa, as mentioned, has long established and developed capital markets, and in particular, equities and bonds have been our preferred asset classes for many decades. And then coupled with that, we've had a highly sophisticated and deeply institutional market, which has had both local and international clients for these many decades. It has resulted in us responding to and diversifying the ecosystem to be quite international in standards, very responsive and receptive. And despite the cyclicality of pushes and pulls of markets, South Africa still boasts highly liquid markets, deep and liquid markets with very strong market quality on the foundation that it was built, or the market structure that it evolved. And so you also see in times of hyper volatility, South Africa as an EM proxy play really reignites its appeal factor. And South Africa, by nature of the way we trade as an emerging market, offers deep value for the marketplace. It gets exacerbated in periods of hyper volatility, but then that said, offers deep value proposition for international investors. So those are just but some of the aspects in terms of how our markets function, the diversity of our ecosystem and players, the sophistication of our institutional clients, which forms the bedrock of that liquidity, and then the way our markets have evolved have really been of global standards to allow very diverse clients to participate in our market.
Fabulous, and we'll come into the secondary market, if you like, or that group of clients in a second. Kevin, tell us what do you see as the main appeal here? You're on mute.
Classic. I think Valdene nicely covered a lot of the points. I think, look, in short, South Africa is an emerging market, but it actually offers a first world capital market ecosystem. With a good range of asset classes. As mentioned, we have a strong and robust regulatory environment and an independent legal system that protects investor rights, and it's obviously important when coming to any new country. It's a market with a deep history. It stems back to the late 1800s, and it punches well above its weight in terms of the market cap to GDP ratio. It has close historical ties to Europe with many cross-listed companies. I mean, at last count, I think some 60 of the 300 companies are either dual or cross-listed. We believe the emergence of competition in 2017 has helped us also better align with international experience. Competition has put downward pressure on fees, seen the rollout of new order types, as well as attract additional liquidity and assist in narrowing bid-offer spreads. I also think very important in looking at any new market is we have a very vibrant broking community that includes both local and international banks, as well as specialist niche brokers. They provide a wide range of investor service, from research, corporate access, to the latest breed of algorithms and best execution smart order routers. So yeah, I think we're well positioned. I think South Africa, offers a gateway to potential growth, not only in South Africa, but also in the sub-Saharan region. And this is really just my personal opinion that, we've recently had an increase in the offshore allowance for the institutional market in South Africa. And I think a lot of the focus is offshore and not onshore. And as a result, it is creating some nice value opportunities for investors.
Very good. Okay, thanks for that. I'll stay with you, Kevin, for just a minute, and then come and bring you in, Merlin. Tell us a little bit about the liquidity landscape. Obviously we have the primary, secondary execution venues with us today. But what other sort of market participants are in the marketplace? How would you characterize the market?
So you've kind of mentioned it in terms of, you've got the historic national exchange, the Johannesburg Stock Exchange, which was mentioned, been around 134 years, is well known and well respected. And then I think, if you look at A2X, established in 2017, we operate much like an MTF, as you'd find in Europe, and currently have 183 securities listed, combined market cap of about over 9 trillion rand, and some 31 of the top 40 companies listed. We cover about 72%, 73% of the tradable liquidity. So from that perspective, I think it's healthy that we have choice in South Africa and an alternative venue. If we look at like the liquidity profiles, I think we're kind of middle of the road in terms of running at about 30 or 34% liquidity profile. But what's interesting, if we look at kind of the underlying breakdown, we've seen a very similar trend to what we've seen in Europe, with the lit continuous market coming under pressure over the last 6 years, making up about 62% of the trade. And the other side of that, we've seen growth in the closing auction. Auctions now make up about 25% of all trade. Cross trades and off-book trades have also grown at their expense. And then if we look at kind of the liquidity split, if you're looking across the exchanges, I mean, not surprising, the JSE still dominates, but A2X now accounts for somewhere between 6 to 8% market share in continuous trade and its universe of stocks. End of last month was about 4% in off-book trades, and also recently released a bunch of new order types to compete in the auction and the cross trade space. And if we kind of dig down to some of the independent stats in terms of the BML stuff, which is obviously an independent market analytics company, it'll show you the JSE has deep order book and a greater portion of the trade, while A2X mostly dominates the top of the order book and often in much greater size. So, yeah, I think the evolution of competition is helping develop and grow the overall market and make all better.
Very good, thank you, Kevin. Sorry, Merlin. Let's bring you in to the conversation. How do you see that sort of the sort of liquidity landscape?
Yeah, thanks, Kev, for leaving some stuff for me. You kind of covered most of it, but if you look at the market in total, this year market volumes have been down. We've seen it now trading around $1 to $1.2 billion a day, which is still a good amount of liquidity in the market. Lion's share still being on the JSE, as Kevin mentioned, around 375 listed instruments in the equity in terms of companies, ETFs, ETNs combined, and A2X has done well in terms of getting more than half of that. As a big broker and a bank in the market, we support competition. It's brought about a lot of innovation in terms of algo usage, in terms of smart order routers, in terms of best execution for clients, and obviously competition in terms of bringing down pricing. And then the SA market is now at a point where we've got fully integrated systems in terms of execution, post-trade, and reporting, and it's in a healthy space. And that's, from a broker's perspective, it's really good to see.
Very good. Okay. We're going to come on in a second to opportunities and challenges posed by the choice and the fragmentation of liquidity. Let's have a look at the poll answers, if we may, and ask the panel what they think, whether they've got any major surprises here. Major obstacles seen by our audience today is the complexity of setting up connectivity and infrastructure. Seems to be the biggest hurdle. Obviously, we have an audience of technologists within financial organizations, so perhaps that's not surprising. Anyone on the panel got any remarks about that? Is that surprising?
I can take this, if you don't mind.
Go ahead. Yeah, go on.
Yeah, so in terms of complexity, in terms of setting up connectivity infrastructure, I think South Africa is, well over that hurdle. many years ago. In 2012, the JSE moved on to Millennium. In 2014, they introduced colocation. And around that time, we saw a number of international connectivity vendors come into the market, either the big shared infrastructure providers or the large connectivity providers, network service providers. And we've had numerous international clients connect down in South Africa. In terms of co-location, either at A2X or in JSE, the fees are really low. It's a few $100s to $1,000 to $2,000, depending how large a rack you want and the power. And we've seen demand from clients globally because it's so low to come into either of the colos or connect down in South Africa. And by having so many international investors connecting to SA, many of the banks and the larger brokers already have connectivity to the big international fix hubs. So, connectivity and routing down into SA has the issue is pretty much non-existent.
Okay, great, thank you. And we'll delve into that a little bit more detail in a while. Let's move on and go back to Valdene and ask about some of the opportunities and challenges, and you saw how our audience voted, posed by the fragmentation of liquidity in the South African marketplace. Valdene.
Yeah, I think, I'll start with the opportunities first. And in any marketplace, competition is healthy. Competition brings about new levels of client service, new levels of innovation, competitiveness in pricing, as well as competitors as a destination, which just attracts flows to a whole ecosystem. And then you don't only compete in a national, in a regional or a national domain, because as Kevin had rightly pointed out, except the stat is a little bit high, we have almost 30% of stocks that are dual listed through the forms of dual listings or even ADRs or any form of liquidity. So you actually have a very competitive market, both with local and international markets. South Africa is no different to other markets. So we have a very concentrated market, and I'll come to that now in terms of some of the challenges with liquidity. But our corporates, Kevin had highlighted the point of we have very strong corporates that actually the market cap of the JSE in particular, the South African market, stands well above that of the GDP of the country in terms of its ratio. And that also shows that our local corporates have become global companies. So you have opportunities to get access to a well-diversified marketplace. South Africa grew up as a mining hub. That's what started the capital markets, but it is actually quite diverse in the cyclicality of markets right now to represent various sectors. And then you get quite defensive plays either through currency hedges or through just exposures of business. So those are some of the opportunities. And like I mentioned previously, because of the frameworks in which the markets have been established, are very competitive opportunities in terms of how we stack. I think we hold ourselves to world-class standards. And even where we don't face direct regulatory requirements from international markets, we often hold ourselves to the highest standard where applicable to have this easy pathway, either for our dual listed trading, attracting in international and local clients, and a healthy mix. So I think those are some of the opportunities. South Africa stands on the front foot of globally competitive product innovation, client appeal factors, the technology that we supported. However, notwithstanding that, it does have the challenges. One of the challenges is the relativity of our market. As we've seen, as other emerging markets have flexed in their own appeal, South Africa has relatively shrunk. For example, in the 5-year period up to this, we had the flex of markets like China, Saudi Arabia, Argentina, Kuwait, that came and saw South Africa actually reduce in just global weighting, and we still a very actively or index benchmarked marketplace as a global economy, even when there's passive and active management splits. So that really does affect some of the challenges. We are no different in terms of the concentration of liquidity. So that would be another challenge in terms of the fragmentation and what that brings. There's the right size for a marketplace in what you can absorb as healthy fragmentation versus the opportunity cost of either dislocating flows, hard to find flows, expensive to navigate venues, market data, best execution or order routing. Those are all challenges. And if you look at South Africa, even in our most robust absolute nominal terms in liquidity, we have concentration of marketplace. So even with 300 counters, You see in the equities market, lots of the trading flow, because it's institutional by nature, is sitting between the top 60 to 80 counters. So you actually have a universe of 200 or 220 stocks that don't get the depth of it traded versus different markets, not dissimilar to developed worlds, bar probably Australia and Hong Kong, that have a good breadth traded. So those are some of the challenges of fragmentation. It's about ensuring you get the right competitiveness in your market quality and liquidity, product innovation, and diversity of client, versus managing the cost of either dislocating flows. And those costs of flows to navigate that have to go through cycles. And as Merlin rightly pointed out, this year was a tough year for South Africa because we actually shrank to relevance in global portfolios to 3% of global index weightings in EM perspective. And most individuals are underweight, as well as even our locals had a slightly sell bias with their offshore limits extending. So those are the cycles you would have to endure. But the bedrock of that is ensuring your marketplace in market quality and liquidity remains quite robust. So to the point that Kevin highlighted, South Africa has pretty much its trading book because for a full day, but because we are closely associated to either dual listing counters in international markets or mix between local and international clients, we see that trading liquidity spread out. So we talk about the addressable liquidity, and you do see it, when the UK opens or when the US opens, you see these flurry of trading. We have 25% of trade activity sitting in the closing auction. So those are metrics that you have to navigate, whether it's for your institutional clients or your low touch clients, low latency clients. You have to have a diverse product offering. And I think those are the opportunities for how we navigate competition, is what is right and relevant for the South African market to stand in terms of an appeal factor to any of these local and international clients, and then to attract flows on a merit basis to our country, which I think is opportunistic at the moment. It's not with rose-tinted glasses, but with South Africa offering such value, having a framework that is really competitive, and then also showing potential in underweight positions. I think we are on a good innings now to catch the next cycle should markets turn into a more risk-on play for emerging markets.
Excellent, thank you. Thanks very much, Mike. Let's bring you into the conversation. As you see it, from where you sit, obviously you're getting more active in South Africa due to your clients' interest. Opportunities and challenges.
Yeah, it's interesting, right? So unfortunately I was close to MiFID than I would have liked, and had to get pretty hands-on in that during my career. And it's kind of interesting having been through that. I mean, obviously on a slightly different scale, and seeing the kind of the opportunities and challenges that created. I mean, obviously, Valdene touched on sort of tighter spreads, reduced costs, hopefully increased liquidity, and certainly more interesting potential trading opportunities, right? And I think you're starting to see a little bit of that filter through in South Africa now from the conversations I've had with clients, and that's the sort of positive side of it. I think one of the other interesting things, which is maybe specific to South Africa at this point, is when you look at the international players versus the domestic banks, at the end of the day, as Valdene and Kevin touched on, South Africa is a specific market. It's a smaller market, and for those big global banks, how do they prioritize their investment? Do they want to build out the connectivity, the smart order routing, the algorithms, and so on? And that, where does that rank on their global investment or in their technology versus the size of the opportunity? That actually opens the door for the domestic sell side. So the more kind of proactive guys who've invested in the market and are building out those tools and capabilities have put themselves in a really good position to kind of benefit from the fragmentation that we're seeing in the market. So that's quite interesting. It's actually sort of like a fillip to the domestic sell side who've embraced it. And ultimately, I think it does create a more attractive destination for international investors. And as both Valdene and Kevin pointed out, the level of sort of regulation, market structure, and so on in South Africa is very mature, given the kind of dynamic investment opportunities it creates. I think, now again, learning lessons from MiFID, some of the challenges one has to be a little bit careful with, maybe not such a big issue. Things like price formation, it's not that fragmented at the moment, and certainly from what I'm aware of, the bigger vendors have they're providing the market data on both venues. But that kind of leads to my second point, which is, it has a cost implication, right? So I think one of the things that wasn't talked about enough in MiFID was the increasing cost of participation, right? So you have to invest in connectivity, market data, and so on. So there is an element of how much fragmentation is good for the market. I think South Africa has not gone that far. I think it's attractive for what's happening at the moment. But ultimately it's about weighing up those advantages versus additional costs. And it's the same with the international players. What's the cost of investing in South Africa versus the benefits, and it's the same with how does the market structure evolve. It's cost of participation versus the benefits. I think we're on the right side of that at the moment, and I think it's really interesting seeing A2X come to the market. But for smaller markets, how much fragmentation do you really want? And certainly with MiFID, we've some of those initial alternative venues, MTFs, have sort of disappeared or got rolled up now, and there's a bit more of a sort of balance perhaps than there was initially.
Maybe there's some lessons learned, Mike, from MiFID when we had that explosion of new venues, which obviously they couldn't all survive. It wasn't really. Okay, fabulous. I've got a stack of questions from the audience, which we'll come to in a moment. But I wanted to ask one more question as per our script, which I'm going to throw to Merlin, because it flows on from what Mike is saying. Given all you've heard, Merlin, how does all this affect the balance between local and global market intermediaries in the marketplace as of right now?
Yeah, so Mike was spot on there, right? So when it comes to firms that are looking at trading on A2X and actively trading on A2X, it's mostly South African banks and brokers. And when it comes to ranking and priority with the globals, South Africa obviously sometimes falls way below on the list of priorities because of the size of the market and what's going on. But that's given us as local banks a massive opportunity to capture new clients. Clients who want best execution, clients who want smart order routers already working and functioning in the market, sophisticated algos. And we've seen that come through with new clients coming on board to us to offer best execution between the JSE and A2X, because there is tighter spreads on A2X. There is no BDA fee. It's a per rand fee, which does make it really attractive for market makers to bring in tighter spreads. There's no market data fees on A2X. So all these things coupled does make their market a lot more attractive to internationals and some locals. And then, we continue to see that there will be, we believe there'll be more competition in the space next year from internationals, because our clients have told us that, the internationals they trade through are going to be trading on A2X, during the course of next year. So it's a real push for the locals to try and get on as many clients as they can in the next 6 months.
Very good, thank you. And Valdene, how do you see that split between local and global? Does that resonate with you, what Merlin just said?
Yeah, I think it's a function of the venues, it's a function of the connectivity, and to that earlier question you asked, the complexity of infrastructure and connectivity. And also it was the risk from some of the globals who shrank out of our markets in how you service the market, whether it's a function of MiFID, whether it was a function of the credit risk rating for the country, you did see a risk of. So you have seen the local banks really go hungry after flow, which is awesome. Again, that's another concentrated segment of our market of how the flows shift. But I also think that the ease of connectivity, which is a building blocks for all of us, I think, in the ecosystem, whether it's the interoperability that we're all striving for, whether it is the tech and the connectivity and how you stack in the priority of just global infrastructure and capital allocation, all of that is what we're trying to work as an ecosystem to make the appeal factor right. So you get a healthier balance between local and global market intermediaries. It makes us all more competitive. The brokers become more competitive. We become a sales force, a united sales force for South Africa in attracting flows to the marketplace as a whole, because then it lifts the whole tide for the ecosystem to say South Africa is relevant. So I think we are all on the same objectives of saying whatever it is between the balance between local and global market intermediaries, we want to iron out any of the bottlenecks to really make South Africa an accessible destination. And it's quite evident in all of the pushes that we are making. I really just underpin all of this and underscore this is to the points that Mike had raised. There's one element to chase flows, but it's not to compromise your market quality and liquidity. And if we stay within the frameworks of what the regulatory dictates are, and then to have really resilient and strongly integrous markets, I think then we would be net beneficiaries of attracting both local and global intermediaries in terms of healthy sales and healthy competition.
Great, excellent, good. Okay, look, we've got quite a lot of questions from the audience here, which just I think reflects, interest and just lack of knowledge about the marketplace. So let me, if I may, panel, just throw some questions. Some will be obviously direct to individuals because they're most relevant. So let's kick off with this one. I think I know the answer to this, but let's get it clear. Can trading firms co-locate a JSE? And if not, where are the best places to co-locate servers for trading in the South African markets? I think I heard Merlin talk about co-location earlier, so I guess the answer is yes. But let's also address the second point. What if I want to just trade generically across everywhere, link with everybody? Where should I co-locate? But first, Valdene, we can co-locate with you, right? You're on mute, I think. No.
Can you hear me now?
Mute.
Okay.
We've lost sound.
Can you hear me now?
Yes, we can.
Great, thank you. So
yes.
Absolutely, you can co-locate. The journey has become a lot easier. We have extended those services. So it's a 2014 journey to date. So well-established co-location center. And really it was for tackling high touch and low latency flows. And it still remains a growth ambition of the JSE for trading flows that reaches a saturation point in most developed markets. And then we further extended our offering this year to add Colo 2.0, basically shared infrastructure services, just to make it easier, more competitive. You don't have to manage your capital investment. You don't have to wait for priority stacks in your global organization. So absolutely, there are various co-location offerings at the JSE, and to access the whole ecosystem as a whole in terms of the trading objectives. So yes, really proud to have a world-class co-location offering.
Very good. And let's broaden it a little bit, Kevin. I mean, for those who want to sort of not necessarily co-locate, but maybe sort of proximity hosting, single point of presence in South Africa, connect with you guys. How does that work? What are your options?
Sure. So maybe firstly on the co-location question. So A2X hosts this infrastructure at an independent data center called Terica. It's about 15 km out of Sandton. Yes, we do offer co-location, so that option is available. If you are going to have a point of presence, I mean, we would argue that actually Terica is a great place. It's kind of, it's an independent, it's where a lot of the lines come into South Africa, and it provides you accessibility both to A2X and to the JSE very easily. They're high or low latency links between the JSE and Terica, so it's easy to access both markets.
Very good. Merlin, anything to add? Mike?
I was just going to say, we've also been working with firms like Merlin's over the last couple of years to create a kind of local order routing fix hub that's already connected to a lot of the large international order routing networks. So making it very simple for investors to connect to domestic brokers or member firms on the ground. So, if you're using LSEG's ADR or ATR or NYFIX or any of those kind of big order routing networks, and you want easy and simple connectivity down to the domestic sell side, we can make that pretty seamless and help firms connect very easily. Excellent.
Good. Okay. Let's go to the next question then. Again, we're getting nuts and bolts here, guys, so bear with me. Which network providers connect to JSE and A2X? Is it people like TNS, BT Radiance, well known here in these markets?
Was I answered? Oh,
Yeah. Go,
well,
Merlin.
you're mute again. I don't know why. It's your sound again. Yes. So, the big names are here connecting down to South Africa. BT Radiance, Avelacom, ICE, etc. has got Pico, Options IT. They all have connectivity down to South Africa. And then when you come into South Africa, it has to be via a local carrier. So then you use Internet Solutions, or you'd use Dark Fiber Africa to connect between the exchanges. But when it comes to connectivity into South Africa, there's quite a lot. The JSE has a network service provider list on their website that if anybody's interested, they can have a look at that.
Yeah, and maybe just to add a little bit is this, because we have a well-established marketplace between local and international clients, then a split between high touch and low latency trading, and then a really deep active market in the dual listed, with then the FX appeal in many of the ARB trades, that plumbing is well oiled in terms of the past decade of how that's been established and serviced by local and international intermediaries.
Very good, thank you. Okay, I'm going to keep plowing through these audience questions because they're real, and people are really keen to understand how things work. Let's ask our two exchanges here. What percentage of trading activity is attributed to algo/high frequency trading? And technically speaking, what is the nominal trading latency offered by JSE systems in Colo? So do you want to know the first one first is about proportion of algo/high frequency trading? Anyone got a feel for that? Merlin, you're sort of laughing over there. It sounds like
just for a disclaimer, Merlin's going to answer the second question because he was a sales guy for the JSE for Colo.
He knows that by heart.
Just to answer the first part, it's really hard to track with 100% certainty what is high touch and low touch. What I can say is what has changed is when we first brought in colocation, it was like almost synonymous with high touch or high frequency trading. However, the style and the makeup of those liquidity providers has changed into more institutional. Secondly, almost 2/3 of the JSE's trade activity now comes to co-location because it's just a means between agency or high frequency trading of how you justify, how you connect to venues, and it has been so easy to connect. And then just to highlight from what we've spoken to on the trading desks and the flows we've seen, to be quite frank, in the last 3 to 5 years, we've seen a sell down of basically agency or fundamental in offshore investors. So the flows from offshore have been largely high frequency or algorithmic trading in essence, and they generally face our market on swaps. So some type of disintermediated product, not holding the equity underlying. So there have been estimates in terms of what percentage that is. I wouldn't like to quote it on a public forum, but it is a healthy balance in the cycles between institutional, low latency, and then agency trading. So it's a very healthy balance, and they ebb and flows with the cyclicality. And we manage that on the market quality metrics. How does that balance and diversity of client flow actually face our market in terms of what is it doing to the market quality and liquidity? And Merlin can maybe answer in terms of the connectivity. If not, I will have a very, very deep technical specialist get back to the participant on all the technical specs.
Very good. Merlin, anything?
Yeah, happy to answer that as well. Because Absa has multiple racks in co-location. So, we're happy to host clients if they're interested and give them access into the market. But in terms of the latency, you'd have 10 gig fiber cables connecting into the rack from the top of the rack, and the JSE gives you a port. It's a 12-port top of the rack patch panel, and from that is cables directly into the trading system and market data. For trading, the execution latency is going to be roughly about 120 microseconds. That includes the matching engine as well on the JSE. I'm not sure. It's probably come down with the last upgrade by another 10, 20. So work around 100 microseconds.
Very good. Okay, thank you. Thanks very much.
I can give you the stats. I can give you the stats for A2X. So we use the Aquis matching engine. Obviously, it's UK based. Internal round trips about 16 micros.
Very good. That's Aquis, you said, yeah?
Yeah, so we use the Aquis system, correct.
I think we're supposed to probably mention there, Val, is the JSE uses the Millennium IT platform.
Yeah, I think we covered that earlier. So yeah.
I mean, so we've seen a lot of internationals come through because it's kind of a plug and play, right? Because it's based all around the world.
So just to highlight on the Millennium solution, it's owned by London Stock Exchange Group and has been a deep legacy system, except it's now hosted at the JSE since 2012. And because of the dual listed, as well as from the time zone and the way the clients face through the international brokers, which were typically located in the UK, it's been quite easy to deploy from a tech perspective and very easy for clients to connect.
Yeah, and I think if you look at what A2X and JSE are doing, it just underlines it's very robust infrastructure. I mean, it's kind of interesting. You've got this like emerging market opportunity, but very robust technology and regulatory environment. So it's almost a little bit of a unique market from that perspective, right?
Yeah, I'm just on that. I mean, coming back to one of our questions and something that was just mentioned about best execution. There is an incoming or an emerging best execution regulation. What do we expect the impact of that to be? Kevin, can I throw that one at you?
Well, I'm glad you threw it at me because they're very, very close to my heart, best execution. It's been a bit of a frustrating ride for a young exchange. I mean, to add a little bit of context, you know, at the time the regulator was the Financial Services Board, they issued 4 new exchange licenses between 2016 and 2018. And they've never released any kind of like enabling regulation to deal with leveling the playing field and kind of taking account of competition. And that means things like the MTF model, post-trade interoperability, but importantly, best execution. So there's no overarching best execution in South Africa. And as you can imagine, for an exchange building, that's an important piece of regulation. So to be fair, and as kind of mentioned earlier, the local banks and a number of the niche brokers have grabbed the opportunity and they already provide their clients with best execution. They've put the infrastructure in place, the smart order routers, and they are pitching that to their clients. Somewhat frustratingly, and again, covered earlier, the internationals, in terms of priority, have been more difficult. They've been slow to respond. And I guess it's a combination of, you know, priorities, but it is surprising given that they're already trading across, you know, in Europe. I mean, how many venues are they trading across? You know, 30 plus. That it should be largely plug and play. So there is a draft conducts for market infrastructures regulation in the pipeline. It is due out in the next couple of months. I was told by the end of the year, but unless anyone knows differently, I suspect we won't see it until next year. And I think that's really positive for the market. I think it makes brokers who haven't adapted to a changing environment to have to put policies and procedures in place that allow them to demonstrate how they're getting the best result for their clients. Yeah. And I think that's important.
Yeah, and maybe just one small thing to add. I think, you know, equally so, very close to the JSE's ambition. Just one nuance to highlight from what Kevin had stressed. There is a very big difference in how the best execution rule is being proposed in the South African market structure versus the European. So without getting into technical, there isn't a wholesale adoption being proposed in South Africa. It is worded such that if you have a broker connected to both venues, then it is at the onus of the broker, the connecting member, to defend and support best execution. However, our local ecosystem, even our local buy side, as well as the local and international brokers that service the market, because they trade with the number of stocks that trade between South Africa and international markets, have already put in metrics in their own frameworks as what they define as best execution. With the buy side, they do TCA, which is their transaction cost analysis, which is a form of best execution for the buy side metrics, and then the sell side responds appropriately in their value proposition of the offering. So I do think that's a really important element to stress, that it is not the exactly like for like. And I think in the European markets or the UK markets, it's really important in prescribing the wholesale adoption because of the various ways you can connect to the market and the multi-venues. However, in South Africa, as an exchange framework, it's left at the onus of the joint members. And because our members are at international standards, at even our local banks just hold themselves to the best quality of markets, support their best execution capabilities across whatever mechanisms they trade. South Africa versus international, that's JSE versus LSE sometimes, or local competition. So I think South Africa will stand in good stead in terms of how it defends and supports best execution on the highest quality of metrics.
That's an interesting point, actually, because actually if you're a European-based entity and you fall under MiFID regime, even if you're trading South Africa, you're still governed by the sort of MiFID regulations, and firms are set up, international firms are set up around the whole sort of best execution premise. Ultimately, like, it's a good thing for the market, right? It's a good thing for the end investor because there's a focus on execution quality, which is ultimately coming through into the price and quality of execution on trade. So I think it's a really positive thing. The challenge will be that, and we saw this in Europe, and obviously it's a much more more highly fragmented and more complex market in many ways. But getting when the actual formal regulations come through, so there's one thing having execution policies in place as a broker, but when all the reporting requirements come through off the back of that will involve a lot of work by the sell side firms to put that in place. So it's something that they need to prepare for, but ultimately it's good for the market. And again, it feeds back into this whole South Africa is a mature, well-regulated market. It's got kind of international policies governing it. It's an attractive place for international investors to look at. And I think that all feeds into that story. And yeah, it's a positive thing for the market.
Very good. Merlin, you got anything to add on that? Okay, fine.
I think it's covered well. Thanks.
Yeah, I think we've covered quite a bit. But sort of relatedly, I've got a question here for Kevin and Valdene from the audience. Do you envisage there will be a consolidated tape in South Africa anytime soon within Bloomberg or Reuters? What do you see the benefits in terms of visibility, best execution, etc.? So any thoughts on that, guys?
I can kick off. So it's already in Reuters. You can find the consolidated or a composite. So it's readily available. It's readily available on Iris. In Bloomberg, it's a good question, and I think the challenge there is obviously that's probably the most used system. So it's half in Bloomberg. So you can find A2X prices using the code and using AJ as opposed to SJ. But even if you type in SJ and you go to the market depth screen, there's a little box you can tick, and you can see a consolidated depth across the two markets. So it's kind of partly involved, partly there. And there's a lot of pressure, at least from our perspective, to get it fully implemented in Bloomberg. I'm very aware of the challenges they have. But I think we will get there. It's just a matter of time.
Very good. Valdene, anything to add?
Yeah, I think I smile because I think 20 years ago, the conversation was all around how many decimal places markets would absorb. And now even in really fragmented markets, for example, the US, the consolidated tape still remains a complexity to navigate. So certainly it's another point of right-sizing the market because we have largely just two venues in South Africa that have dual-listed stocks being A2X and JSE, and then many dual-listed counters between JSE and various facets. I think the ecosystem has worked a way to anyway get prices real time across venues, because it's not just with local A2X that we need one consolidated tape. It's across LSE, the ASX in Australia, Canada, we have many dual listed, New York. So there'll be various forms of this as market access changes and where you can get these stocks. And certainly if we get to add other types of venues, not just exchanges. So it will be an evolution, but I think there's ways in which the ecosystem can navigate against collective or consolidated prices on dual listed counters.
Very good. Okay. I'm mindful of time, so I'm going to ask one more audience question, and then hopefully we'll have a sort of forward-looking question to end on. Okay. Because I really like these audience questions. They're really sort of hitting the nail on the head here. This one, I'm not sure I understand, but I'm going to do my best with. Okay, so since the inflation-linked RSA retail savings bonds used to hedge inflation are not listed, that fact, coupled with the restricted transferability of bonds to a third party, the question is, how does the bond market guarantee sustainable liquidity over time? Does that resonate with the panel? We've lost your sound again, Valdene.
Can you hear me now?
Yep.
Yeah.
Okay, I think there's a link here, sorry. So I'll try my best, and how I understand this question is liquidity of retail bonds, because that's the only retail bond product I know, which is yeah. So if it's not the right question, we'll figure it out, because the rest of the bond market is not retail. It is govie bonds and institutions between banks. So on the retail side, absolutely, there'll be a liquidity issue on those retail bonds. I'm happy to figure out, if we can help facilitate that through the conduits of this, although those are not highly liquid instruments in general. I think some of the other African markets have better liquidity in their retail bonds market, certainly the case in some of the developed markets like Italy, for example, on the retail bonds. Happy to pick that up offline to try and best help someone get out of the market in that, or in and out of those retail bonds, but it's not really a highly visible product in the South African capital markets.
Okay, thank you, Valdene. Merlin, you seem to have some thoughts on that?
No, well spot on. It's a retail government bond. It's not going to have much liquidity.
Okay. All right. Well, we can put the person who asked the question in touch, Valdene. Okay. Look, we're running out of time, so let's. I think we've touched on most of the points we wanted to raise, through our audience questions. But let's just quickly go through the panel, starting with you, Merlin, with a forward-looking question. I think what we've heard is that the South African trading ecosystem is well established. It's got most of the modern, facets of a modern trading infrastructure. So looking forward, what will South Africa do next, and what role will it play across wider Africa as a financial center? And how does that translate into opportunities?
Yeah, that's a great question, Andrew. So South Africa is already primed to help the rest of Africa in terms of liquidity. We have, large internationals that connect down here. We have big HFT firms. You have algorithmic trading firms trading into South Africa. The problem with a lot of the African exchanges is they don't have lots of central liquidity, unbooked liquidity. And there are a few forums or committees that have tried to create a linkage project, but unfortunately, it's been unsuccessful. So what you're going to need is you're going to need a big bank or a broker to stand up who has presence, who wants to take on the challenge to connect to these African exchanges, knowing that it's not going to yield results for the next 5 years in terms of paying back the bill. This year, Absa, we decided that we're going to choose a new exchange in Africa every year and try and help them with liquidity on screen. So the first market we chose this year was Kenya. We engaged the exchange earlier this year. We're the first bank globally to connect directly into the exchange and have our systems coded up to them. We just got approval as well for our systems, and we're going to be applying to the regulator to approve that. This means Q1, Q2 next year, clients of ours in South Africa would have the ability to execute orders in the central order book in Kenya via Absa. And if we continue to do this, with the new market every year, before you know it, we would have a really compelling offering for all of our clients to connect into us globally. And I think that was the challenge when we pitched for business abroad. A lot of them came back to us and said, well, electronically, I can only trade JSE with you. My prime broker offers me JSE, London, New York, etc. What's your differentiator? And that really made us think. So, our differentiator is we're going to be the prime broker of Africa. So forward looking, I think you're going to start seeing these markets slowly, see liquidity on screen.
Very good. Excellent. That's very, very interesting. Valdene, how do you see it panning out?
Yeah, I hope I'm not on mute. Can you hear me?
Oh, we can hear you.
Okay, great. Absolutely. So I think this is a long conundrum to solve. And African capital markets hold such awesome opportunity because they can still develop and they have scale behind them that has not yet been unlocked. What we do is we certainly see South Africa as a point in which we can catapult that in various facets. But it comes down to, if I had to just summarize it quickly, two things: liquidity and then trading, regulatory, and policy certainty. And those are still challenges across the continent. So as a JSE, we often try to figure out how we can address those two within the framework of what we hold as really appeal factors to our market, and often it's offering access to African counters through the JSE, or then working with some of the other exchanges just to try and help them in those metrics, establishing a derivatives market to support cash market liquidity, etc. So it is a journey. It still holds opportunity. It is really amazing to hear that the ecosystem gets mobilized. If brokers get mobilized, exchanges get mobilized, you can let some magic happen, and then you get trading connectivity. But there are challenges like liquidity and the policy, regulatory, and trading uncertainty that still have to be smoothed out. But I certainly say with our international African counterparts, Kenya, Nigeria, Egypt, we have pretty much weekly conversations to try and help this ecosystem really get into it. And another market, if you're happy for risk appeal, I mean, markets like Ethiopia have the beauty of just starting fresh in terms of no capital markets, and now you can leapfrog. And even like Kenya has shown some really exciting developments. So excited for the continent, but lots of plumbing and foundation that needs to be worked on.
Lots to do, exciting stuff. Unless Kevin and Michael, anything to add? We'll
the only comment I'll make is, obviously for looking at this from a technology lens, is it is a dynamic and evolving market, and I think one of the things firms will need to look at is technology that will both help them implement and innovate and respond to change, because as I touched on before, just things like some of the reg reporting that's going to come with BestEx. BestEx is great, but it's got implications, right? So I think that will be something the market has to look at as we go forward, and how that technology evolves to support that change in the market.
Very good. Kevin, last word?
Look, I think Africa is both an opportunity but a huge challenge. I think a lot of the challenge is actually going to be political. As Alistair Haynes said to me, in Africa, they want to have a flag, an army, and an exchange. And to break down those barriers is going to be challenging.
Very good. Well, this is a small first step in the right direction. Thank you so much, all of you, for joining us today. It's been a great session, actually. I've learned a lot. I hope the audience has learned a lot. Sounds like we had a lot of questions, which means that they needed to, which is all good news. So thanks for joining us, everybody. Just a last couple of words from me. I urge you to take a look at the various webinars we have coming up. So those should be viewable on your screen around and below this screen here. We also have a number of conferences coming up in the new year. So please feel free to sign up. If you've got your phone handy, maybe you can access that QR code for our next Trading Tech Summit here in London, February 29th. Once every 4 years is February 29th. We do the actual event every year, just a joke. But please do sign up and come join us to hear more about these topics. We're all about trading infrastructure and modernization and all those great things that we've been talking about today. So I'd love to see you there on the 29th. With that, I think that's enough from me. I'd like to say thank you once more to Kevin, Valdene, Merlin, and Mike Powell of Rapid Addition, our sponsor for today. Thank you all very much for sharing your expertise, and I look forward to the next one. Thank you all. and goodbye.
Thank you. Bye-bye.
Thank you.
Thank you.
Cheers.
Bye.